California level. Limited partnerships and limited liability partnerships, but not general partnerships, are subject to an $800 annual California franchise tax. That's a flat tax, so the amount will not change based on how much your business makes that year. Next, we'll move to corporations. Corporations are formed by filing articles of incorporation with California Secretary of State. Until these articles are filed, you don't legally have a corporation. And as you may already know, corporations have many benefits, like limited liability, but they're not tax efficient per se. We'll go over the two types of corporations, C Corps and S Corps. So C Corps are taxed at the corporate level. So for federal taxes, the business is taxed at 21%. At the state level, the business pays 8.84% tax on net income. But there's also in California an $800 minimum. So if your 8.84% tax is less than that, you will just pay $800. As the owner or shareholder of this corporation, you end up paying a double tax on income earned from a corporation because business income is first taxed at the corporate level, and then, as I just explained, also at the individual level when the business income reaches you as the owner. For example, if the C Corp earns business income and then distributes that to the owners or shareholders, then the corporation would first pay the corporate tax at the federal and state level. And then on top of that, you as the shareholder would pay up to 20% on dividend income plus 3.8% net investment income tax. And also when you sell the stock, you pay up to 20% on capital gains, which is the difference between the price you bought and then the price you sold the stock for. S corporations. These are similar, but the nice thing is they don't pay the 21% federal corporate income tax. They do pay the California franchise tax, and the rate is lower. It's 1.5% instead of 8.84%. And the minimum $800 threshold still applies. So if that 1.5% ends up being less than $800, you owe the $800. To get this tax treatment, S corporation has to file an S election with the IRS. There's a form. And there are also certain limitations. For example, you can have only up to 100 shareholders. Those shareholders must be U.S. citizens or residents. And S corps can only have one type of stock. LLCs are flexible in that you can choose or elect the tax treatment of the business. Depending on what you elect, the LLC can be disregarded for tax purposes, so the business is taxed as an individual, or it can be treated taxed as a partnership, corporation, S corporation, or a C corporation. Like corporations, LLCs are formed by filing articles with the Secretary of State. If you choose to classify them as a corporation, they have a flat $800 California franchise tax that applies to them, irrespective of income. If they're classified as anything other than a corporation, they're also subject to a California LLC gross receipts tax if your business income exceeds $250,000. So, for example, if income is greater than $250,000 and under $500,000, then the LLC gross receipts tax would be $900. I know this was a lot. Here's a table with the federal income tax rates for each entity. So a deduction. If you are a sole proprietorship, disregarded entity, partnership, or S Corp, then you can reduce the business income that is subject to federal income tax through the qualified business income deduction. This is also called the Section 199 Cap A deduction, and it reduces the business income subject to tax by 20%. So for example, if your business makes $1,000 that year and you get the 20% deduction, you only have to pay federal income tax on the $800. Um, but California doesn't have a similar deduction, so this only reduces your federal income tax. Two limitations here at the bottom. There's an income threshold. So in 2026 for single filers, it's $122,100. If your income is above this amount, the deduction will be limited by the amount of wages you paid and the qualified property you have. And also, if you provide services like consulting, where your personal reputation or skill is the principal asset, then your deduction is limited even further. For example, if your income is over $364,000 and $364,200, then this deduction is zero. In the following slides, we've provided an overview of the state and federal income tax filings required of California businesses, including due dates. Please take a close look if you operate a business, because there's penalties and interest that are imposed for failing to file a required tax return on time. And these are organized by type of entity. So now I will hand this over to Spencer to cover the next topic.
All right, so now we're turning to worker classification, which is whether somebody is your employee or an independent contractor. And this matters because it affects the reporting and tax obligations you have as a business owner regarding people that work for you. We'll get more into those obligations later after we discuss the distinction between employee and independent contractor. So when we say independent contractor, what we're really asking is this person operating their own business and providing services to you, or are they functioning like part of your business as a worker that you direct and control? And the IRS is going to look at three buckets of factors. The first of those is behavioral. So with behavioral, they're asking, do we control or do we have the right to control what the worker does and how the worker does the job? So if you're telling somebody not just the result that you want, but exactly how to do their job, then that looks more like an employee relationship. Second is financial control. So you're asking who controls the business aspects of the work and who's taking on the economic risk. Are you reimbursing their expenses? Are you paying them a flat fee? Contractors generally invest in their own tools, manage their own expenses, and are able to make a profit or loss based on how they run their work. And then third is the type of relationship. So we're asking whether you have written contracts, do you provide employee type benefits like pension, vacation days, stuff like that to this person, and what is the expected duration of the relationship? Also, is your work being performed a key aspect of the business? A practical tip here is that a written agreement can clarify your intent, but it's not going to override reality. So you can have somebody that is really your employee, but you write on a piece of paper that says, oh, this person's an independent contractor because you might want that treatment. The IRS will look through that and just analyze the actual substance of your relationship with that person as opposed to taking your word for it. Okay, and then this is one of the kind of more confusing aspects of the law, but there's not one universal definition of employee versus independent contractor. The definition depends on what question you're asking and what set of laws you're looking at. So for federal tax purposes, as we just talked about, the IRS uses a control-based test. They're looking at how much control you have over that person. But even within federal law, there are different standards depending on what you're analyzing. Federal wage and hour laws under the Fair Labor Standards Act use a different approach. That's called the economic realities test. And then in California, there's again a bunch of different sets of laws governing this. There's wage orders, labor code, unemployment insurance, and workers' comp laws. So you just have to check and think about, why am I asking whether this person is an employee or an independent contractor? What law is going to apply? And then go from there in making this determination. And so if you do all that for federal purposes and you're not sure whether an employee is an independent contractor or an employee, the IRS will issue an official determination after you submit something called Form SS-8. So you'll provide the facts about how the relationship works, who controls what, how payment works, tools, expenses, all that stuff. And then the IRS will make the classification call. Also, even if you never file that form, the IRS does publish practical guidance for employers. So, two resources you can look at are IRS Publication 15, which is the employer's tax guide, and IRS Publication 15A, the employer's supplemental tax guide. These are pretty much the playbook that the IRS is going to look at when they make that determination for you. So now we're on to why this matters. Once you classify a worker, you're on one of two compliance paths, and the obligations look pretty different. So if the worker is an independent contractor, um, you must provide the contractor and file with the IRS Form 1099 NEC, and the threshold for that is $2,000. So this is for independent contractors to whom you pay more than $2,000. Um, if the worker is an employee, the business becomes responsible for withholding and paying federal employment taxes. So you're running payroll. You withhold amounts from the employee's wages, and you also pay the employer side employment taxes.
Okay, back to California, state and local taxes. There was a question in the board, and it just had to do with whether the FTB will bill for franchise taxes. And so, um, yes, like any regular state taxes, the FTB will send you notices with your bill and any interest and penalties if you haven't paid them. It's not special just because they're franchise taxes. It's all state taxes, same procedure. So we'll go over the state and local taxes that apply to you. California has various types of taxes, and they're managed by different state entities. The details are on these slides, so I'll just explain what and how much is being taxed for each of these. Um, just keep in mind that these are California taxes that are in addition to your federal taxes. So sales and use tax. If you sell tangible property in California, you have to obtain a seller's permit and pay a sales tax. There are some exemptions from the sales tax. For example, there's bottled water and resale items if sold by registered sellers. The rate is 7.25% base plus local rates. For Los Angeles County, the sales tax is 9.5%, which is the 7.25 base plus the local rate. And you can file and pay the California sales tax online. In case you're curious, the use tax is just a similar state tax on tangible items brought from outside of California or online and then brought into California for storage, use, or consumption. So if no California sales tax was paid, then you would pay the use tax, and the rate is the same as the sales tax rate. For franchise tax, we've gone over this. The California franchise tax is basically imposed for the privilege of conducting business in California, and it applies to C Corps, S Corps, LLCs, limited partnerships, and limited liability partnerships. There's also a California payroll tax. If you have employees, you owe payroll taxes to the Employment Development Department, EDD. Payroll taxes are taxes for things like unemployment insurance and these other things. There's always an employer portion and an employee portion, but the employer has to withhold the employee portion and pay them to the EDD. And the rates, they're just progressive and match the employee's individual income tax brackets, so 1 to 13.3%. Here are the rates for unemployment insurance and employment training tax. These are assessed on the first $7,000 of wages that you pay to each employee per year. For state disability insurance, here's the rate. It's just 1.3% of wages paid. And then, as we mentioned before, employers have to withhold from wages the California income tax, which we said was 1 to 13%, 13.3% of wages. And finally, property taxes. Property taxes are imposed on the sale or lease of property, generally real estate or machinery if the business has them. Annual rate is 1% plus another maximum of 1% local. So it's a maximum of 2% total. That's it for California taxes. Now we'll move on to federal taxes.
All right, yeah. So as Julie said, we're shifting to federal tax obligations more broadly. So at a high level, there are two buckets to keep in mind. We have income taxes and employment-related taxes. So all businesses must pay income taxes. This tax is based on net income, which is income minus deductible business expenses. And that'll get reported through the applicable system for whatever type of entity you are, whether you're a C Corp, S Corp, partnership, as Julie discussed. For employment-related taxes, if you have employees, you have additional tax obligations. So employers must withhold income tax from employees' paychecks, deduct employees' FICA taxes from their paychecks, pay employer FICA taxes, and pay unemployment taxes. Also, to operate, you need an EIN as a business, which is an employer identification number. An EIN is required for all partnerships and corporations and for all businesses with employees. So if your business is an LLC, you generally need an EIN if the LLC has more than one member. Okay. And then obtaining an EIN is an IRS process. And once you have it, you should treat it like sensitive personal information. It's kind of like a social security number for your business. You want to keep it private because the EIN will appear across tax filings, payroll processes, and other compliance and financial systems. You want to store your EIN securely and decide who inside the business is authorized to use it. Next up is self-employment tax, which is how Social Security and Medicare taxes apply to self-employed individuals. A helpful way to think about it is that if you're self-employed, you're both the employer and the employee, so you pay the equivalent of both sides of these taxes. So as you can see on the slide, Social Security is 12.4% of your net earnings up to the annual wage base. The annual wage base for 2025 was the first 176,000 roughly of your net earnings. Medicare tax is 2.9% of your entire net earnings and actually increases to 3.8% if your earned income is more than 200,000 or 250,000 for married couples. There's a partial offset, which is that you can deduct half of the Social Security and Medicare tax in figuring out your adjusted gross income for federal income tax purposes. It helps, but it doesn't change the cash flow reality that you need to make sure that you have funded and set aside cash for these obligations. Okay. Now for estimated taxes. So many self-employed people don't have withholding happening throughout the year, so you need to estimate and pay quarterly. So for individuals, the estimated tax process is on Form 1040-ES, and for corporations, it's on Form 1120-W. And if you have employees, there's another major reporting system, which is that withheld federal income tax and FICA taxes withheld are reported on the same form, which is Form 941. The practical point is that payroll taxes aren't just calculated, they're deposited and reported on a regular cadence, and the IRS expects your deposits in your reporting to match. And with that, I'll turn it over to Jacob.
So I'm going to take us down the back stretch here and talk about ITINs and then later more general disputes with the IRS. But so ITINs, or individual taxpayer identification numbers, are a system of identification used by folks who don't have access or the ability to get a social security number. It's folks that have tax filing or payment obligations but can't identify themselves in that way. You have to identify yourself in some way on your tax filings, and so ITINs are the social security number alternative. And the important thing from a compliance and a kind of ability to report perspective is that ITINs expire over time. And we've listed all of the ways below that bullet point as to how they have expired. But the two general buckets are if you haven't used your ITIN on a federal tax filing at least once within the last 3 years, it's expired and you're going to need to renew. And the alternative is the ITINs are formatted as 3 numbers, then hyphen 2 numbers, hyphen 4 numbers. And the middle 2 numbers, if they are between 70 and 87, 88, or certain numbers in the 90s, and your ITIN was first acquired before 2013 and hasn't since been renewed, those are going to have expired in 2025. And the process of expiration and renewal is quite taxpayer friendly. The IRS is going to begin by sending what's called a CP-48 notice. That notice is going to explain that you need to take some form of action to renew the ITIN if it's going to be used in a specified calendar year. It's worth noting that these notices are sent by snail mail and like that process can take some time. And so folks sometimes receive them after having already made the correction, aka like already having renewed the ITIN. And just know that if you receive a notice after you've already think that you've handled it, that doesn't necessarily like generate a new problem that you have to solve. At that point, it would just be recommended to confirm that you have in fact taken care of the problem. And that renewal process is just filing what's called a Form W-7 that can be filed at any time, though it doesn't really impact your ability to file. You just have to make sure you do it. And to drill sort of even more specific and a little bit more in the moment, we're going to talk quickly about ICE access to taxpayer information. So the IRS has been distributing ITINs to individuals for quite some time, and folks with undocumented immigration status felt relatively comfortable receiving an ITIN and paying their taxes with it because it was understood that the IRS wasn't distributing that information to other governmental entities. However, in April of last year, 2025, the IRS and Department of Homeland Security entered into a memorandum of understanding under which the IRS agreed to share taxpayer information, including ITINs, with ICE, which is a DHS subagency, for purposes of pursuing immigration enforcement actions. And that obviously creates individual immigration concerns, but something that's gotten a little bit less attention and in front of this audience is worth considering is that it creates potential criminal and civil payroll tax implications for businesses that employ undocumented individuals. And as I mentioned, there was this data sharing agreement that was entered into in April of 2025. Basically, a taxpayer advocacy organization almost immediately sued to block that agreement, claiming that it sort of exceeded the bounds of what's acceptable under the law. And in November, the district court that was in charge of that case paused the data sharing agreement, basically finding that it was overbroad. The judge, importantly, said that any further communications of taxpayer information from the IRS to the Department of Homeland Security would have to be filed with the court in advance of that information actually being transferred, something like 72 hours in advance. And basically the point there is to give the taxpayer advocacy organization, the court, everyone else the opportunity to review the information request and try to block it before it happens in the future. And something that we kind of mentioned up front, but is kind of particularly important in this context, is law changes over time, and this controversy is ongoing. So individuals and businesses that have questions should consult with their immigration and tax lawyers as appropriate in the future. We're telling you the current state of the case today, but that could change 2 weeks from now, and this should not be relied on sort of in perpetuity. And turning now to sort of more general conflicts with the IRS, I'm going to talk about now the process of what happens once they've decided to make an audit. So the IRS will initiate an audit of your tax return by sending you a letter. They'll also send you a letter when they've made their final determinations. In the middle of that process, the IRS may request documents or in-person meetings during the audit to gather additional information, though it's kind of unlikely to be requested to come anywhere in person except in the largest cases, so quite unlikely. What an audit is essentially is a review of an organization's or an individual's books, accounts, and financial records. The IRS wants to make sure that information was reported correctly and that the bottom line tax liability is correct under the law. And your audit can have one of three outcomes. The first is a no change outcome, which is exactly what it sounds like. The IRS conducted the audit, they found no errors in the return, and the parties are going to proceed as though the audit never took place in terms of what the actual tax liability is. And then you can have an agreed outcome, which is the first of two situations in which the IRS found errors or what they believe to be errors in the original tax filings. But in this situation, you, the taxpayer, and the IRS agreed to the correct results. And so there may be an additional payment required, but you'll sort of move forward in making that, and then everyone will go their separate ways. And finally, you can have a disagreed outcome, which the IRS again proposes changes, but this time you, the taxpayer, understand but don't agree with those changes. And we're going to talk a little bit more about what happens in that setting, because that's where kind of things continue. And so if you find yourself in that disagreed posture, first, it's important to know that the Taxpayer Advocate Service is a part of the IRS and it provides free help to taxpayers in disputes with the IRS. We've included the national and LA phone numbers, as well as the website for the Taxpayer Advocate Service in the slide. And in terms of your other rights that are important to understand, you do have a right to a fair and impartial administrative appeal of most IRS decisions. That means that you can ask the IRS Appeals Office, which is sort of an independent entity within the IRS, to review your case. And if you come out of that appeals process still not agreeing with the IRS and without a resolution, you generally have a right to take your case to court. And in that court proceeding, as well as before the IRS, you can represent yourself or have someone else represent you, an attorney, and in some instances, a CPA or an enrolled agent as well. Now, to dive a little bit more deeply into sort of what the two sorts of disagreements you can have with the IRS are. The first is an underpayment, which is when the IRS says that you haven't paid enough taxes. The things that are kind of important to understand here is you'll have an underpayment amount, like if you call it $100, but if it turns out that that amount is correct, and say your case proceeds over another year, the amount that you're going to have to pay is likely going to be larger than $100. And that's because there are potential underpayment penalties that accrue over time and more quickly if you didn't file a return in the first place, which is kind of just another reason to make sure that you're complying with all of your filing obligations. But even separately from a penalty sort of process, there's what's called deficiency interest. Basically, you have to make the IRS whole for the amount of time that they didn't have the money that they were originally owed. And so that's going to accrue from the time that your payment was due until your payment is later made. And on the flip side, you have an overpayment, which is the situation in which you are claiming that there was something done wrong in your taxes or something done wrong in the IRS calculations. Basically, you can make a claim for a credit or refund, and you're going to have a limited time to do so. It's going to basically be the later of 3 years after you filed the return or 2 years after you made the payment on the tax. And to wrap up here, now that we've considered sort of your time limitations, it's kind of important to understand the limitations on when the IRS can assert that you made an underpayment. And that statute of limitations is generally 3 years from the time that you filed. So anything after that, it's kind of a closed issue that can't be reopened. There are some exceptions to that, though. The first of which is if the IRS thinks that you excluded 25% or more of the income that they think that you made. The statute of limitations, which is just like that time limit, it doubles to 6 years. And if you didn't file a return, you filed a false or fraudulent return, or you in any way willfully attempted to evade your tax liabilities, there's no time limit. So the IRS at any time can assert that there was some sort of error, intentional or a failure to file in the first place. Yeah, and that's going to wrap us up. So I think we're now ready to answer questions. I see things have been accruing in the Q&A throughout the presentation.
Yes, thank you, Jacob. So let's start at the top. Uh, Well, I think this is for Sarah. Does BitSEDEC help with student loan debt forgiveness applications for people working with in nonprofits? Is there any program to help face possible upcoming garnishment activity by federal government? Sarah?
Um, that would be outside the scope of the low income tax clinic, and I don't think that Zedek has a program for that. Nadia, are you
Yeah, I don't.
aware?
No, we don't, but we recommend that the person that has that question reach out to us because our intake line might be have referrals to other organizations, partner nonprofits that can help with that. So if you send an application and include that question or call our intake line, they will provide the appropriate referral.
Okay, thank you. Shamika Harris asked specifically about the 800 franchise tax. And she just asked, I think the question was answered, but just to make sure, if the tax is automatically when you file your taxes, or if there's a separate bill sent from the franchise tax board.
Yeah, I can take that. I think there was a similar question as well below, but basically it's a separate form that you have to file. For corporations, it's CT 100. For other entities, it might be other forms, but it is separate from your California income tax. And even if your income is zero, you might still be subject to the $800 annual minimum, depending on what kind of entity you are. And so you should file separately for the franchise tax. It's not just that you can file your California income tax return and you're done.
Okay, thank you.
Yeah.
Sorry, Vero, and I'm gonna add something on that.
Please.
It's the beginning of the year, so if you are planning to file for an LLC, this is a good time to do it. With the 800 franchise tax is always due. So, for example, at the end of the year in December, we had some businesses that were thinking to incorporate, and they asked us, well, if I incorporate now, will I still have to pay it? And that was yes. So if you file in December or November, you will have to pay those 800 for example, 2025 and then again for 2026. So when you are thinking to incorporate an entity, it's good that you talk with the attorneys that we're working on because this tax is always due. It's not something that is waived. It was way back in COVID, but that is not the same thing anymore. Thank you.
Okay, thank you. Um, Someone asked, at what point of their revenue should an LLC switch to an S corporation in order for it to be tax beneficial?
Yeah, I don't have a straight answer for that. Normally, if your self-employment tax savings are a lot more than the admin costs, that's for tax purposes, I guess, worth making the switch for. But that's I guess most people don't. Taxes aren't the main consideration when they're choosing this kind of um or making this kind of decision, especially if it's a one member LLC to an S corp. I think it's more the form and other issues that are the main considerations.
Oh, okay. Someone asked, does anyone on the webinar, I guess you mean the presenters, provide tax services like preparing the tax return? The person needs help with their LLC tax return.
We no one here does. I would recommend reaching out to a small business program and we can provide referrals to services that might be able to help you with that. We only provide legal related questions and assistance with tax.
Thank you, Nada. Also here at PACE, we can provide referrals as well. Okay. I can answer this question. So the person asks if they need a business tax registration certificate, which is what's required for the city of Los Angeles. The person asks, what is it? So if you have a business, if you conduct business, whether a product or service, you are required by the city of Los Angeles Office of Finance to have a BTRC. There are very few exceptions to it, like if you're regulated by someone else, like the Department of Transportation. So for the most part, you can check in with them if you need it, but for the most part, everyone needs it. You are required to have it. Okay, next question is, if you file your business taxes and you didn't make anything, but you owe for not filing on time, will you file your personal taxes will they take that from your pay for not for having a balance? I guess they're wondering if the business and the personal um, affect each other. Like if you owe, you know, business taxes, and will it affect your personal taxes?
I'm not entirely sure, but I think it would depend on what type of business you are. If 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 you're or corporation, it's separate. But if you're taxed as an individual, it's you don't have limited liability. But that's about the extent of what I know.
Okay. So one person, this is more of a technical issue. He or she was trying to access their business transcript from the IRS website, and they weren't able to because it's an LLC. Um, does anyone, um, I mean, I can technically answer that question. It depends because when you go to the IRS website, they do tell you which businesses you're able to, which taxes you're able to access depending on your business. So there are two accounts. There's a business and a personal. Um, so that was very specific question that you would have to, I think defer to the IRS to help you, but that's a technical question. Oh no. Does California wholesaler selling products only overseas export need a California seller's permit?
I sorry, would not know. I only know the tax part.
Okay. So for the CDTFA, they are the ones that issue the seller's permit. Um, you would, if you don't know, but usually if you sell a product here in the United States, yes, in California you do. So I would defer to the CDTFA. They can issue you a letter, so you can go ahead and contact them, and they'll send you like an email, and that's like a determination. It'll let you know if you can't or you can't. But I would say that's a general question you can ask them, but I would ask them directly. That's not a federal or FTB question. Okay. I'm not sure about this one. It says, is BOI still required for small businesses? BOI still required for small businesses.
I think they were talking about the CTA, which is the Corporate Transparency Act that required those BOI filings, which were basically a reporting that you had to do regarding the owners of the business. Right now, that regulation is on hold and it's only mandatory for foreign entities. So it's still a developing case, like with the ITIN case that my colleagues mentioned. Right now, it is not necessary, but it's something that might change in the future because that is also in the courts. But as of now, it's not required. It's only required for foreign entities.
Okay, perfect. If you're under audit, does the IRS put a lien on your property or take your wages? When, if, does owing taxes impact your credit? That's two questions.
Yeah. So one thing I want to make clear is an audit is just the IRS examining whether the tax return is correct. They're not assessing any penalty against you at that stage. Now, when they do put a lien on your property, that's a collection step that happens only after they've assessed a tax debt. So the IRS has audited you, figured out that you owe some amount of tax, and then put out something called an NFTL, which is a notice of federal tax lien. At that point, they can put a lien on some of your assets and begin to garnish your wages. But it will not happen just because you're under audit. And then on point two about the credit, I just looked it up briefly, but an NFTL is a public document. Anybody can look it up and see that you have it. And so it will go in credit reporting, presumably. But being under audit will not affect your credit.
Okay, thank you. Next question is, when you file a tax extension, do you still get charged any penalties during the extension period? Similar.
That is a similar question. Essentially, what's happening there is when you have asked for an extension, you've pushed back your due date because you've pushed back your filing. So that's not a period during which you're going to be accruing any sorts of penalties.
Okay, and a continuation to that question is, does the IRS or FTB ever give grace on this? Can you request a hardship and waiver for something for penalties?
Sarah, do you want to answer that one? I don't know if you know.
Sorry, could you repeat the question?
Oh, okay. Does the IRS and or the FTB ever give grace on this? They're referring to penalties and interest. Can you request a hardship or waiver or something similar to for the penalties and interest?
Okay, so there can be a first-time abatement for interest and penalties if in the past you have always like paid and filed your taxes on time, and this is really like the first time there's ever been an issue in filing your taxes late. There are also just different collection alternatives available to taxpayers who are unable to afford the tax. So whereas you may not be able to get the interest and penalties waived, if you can show that your income is less than your expenses, you may be placed on like a currently not collectible status for as long as you're unable to afford the tax debt. It is also possible to apply for an offer in compromise where you offer to settle the tax debt less than the full amount because you're able to show the IRS that it would be unlikely for them to ever collect the entire tax debt within the 10 years time. There is also ways to apply for partial payment plans where you're able to afford to pay off some of your tax debt over monthly increments, but you're not able to have enough excess income per month to pay off the whole tax liability. So these are all ways where you may be able to pay less than what you actually owe when you're not able to get that first time abatement.
Okay, thank you, Sarah.
Really,
Not,
Veronica.
oh, go ahead.
Sorry, there was just a follow-up to the tax extension question in the chat, and it prompted me to look it up. There is a distinction between an extension to file and an extension to pay from the IRS. And so while you wouldn't get penalized for a failure to file for receiving an extension, your payment date doesn't change. And so it looks like the person says that they received a bill and that there was a penalty for late payment even though they filed the extension, and it turns out that that is the correct outcome.
Okay, thank you, Jacob. Um, Nadia, I think this is referred to you because the person said you mentioned a 2020 exception to taxes. The person says, what are they? And what if someone never filed the 2020 by accident?
Yeah, so the exception I mentioned was regarding the 800 franchise tax. It was, I think, available during 2020 and 2021, and it was for new businesses that were incorporated during that time. They didn't have to pay that $800 dollar tax during those, I think, 2 years. I don't know if anyone, Julie, Jacob, someone can you just research exactly when was that exception? I don't remember if it was 2020 or 2021, but that is no longer available. And it wouldn't, that was just for the tax, the franchise tax, not for all the other taxes. So you still need to file your 2020 taxes.
Okay, thank you, Nadia. We're actually at time at 11. Are our speakers okay with going a little bit over and answering some of the remaining questions? We have about four. Would that be okay?
Yeah, we can do, or I can do four more.
Oh, okay, good. Um, this one's like a case study. So, okay, the person says, I run a small food business and I'm hiring sales reps to work one farmer's market per week, approximately 6.5 7 hours weekly. The rep would represent my brand, use my products in 10, follow a set schedule, and be paid hourly. I like to test out whether the person is a good fit over the next few markets, but I want to stay compliant with California law. So the questions are, should this role be classified as a W-2 employee rather than independent contractor under California law? That's one question. The next is, if I hire them as a part-time and at will employee from the start, is it acceptable to treat the first shift as an initial evaluation period? And third question is, if the role doesn't work out, when we end employment early, what is my realistic exposure regarding unemployment insurance for such a low hourly position? And I'm trying to structure this in the simplest and safest way possible for her small business.
Hmm. So I can help you with the first two. I don't know much about the unemployment insurance third question. Also want to note that we do not represent you here. Just everything that I'm saying is meant as like part of a general educational presentation. But it sounds like that's a W-2 employee. The person is not really going to be making any kind of profit there. They're doing what they're doing at your direction. Sounds kind of straightforwardly like a W-2 employee. And then your second question about the first few shifts being an initial evaluation period, I don't know exactly what that means. Standard part-time employment is completely at will. So you would pay them hourly, and then either of you are able to terminate that employment relationship at any time without additional cost. Um, you always have to pay them what they're owed at the end of that pay period. Um, but yeah, your employment relationship with that person will be entirely at will. So you can, you know, I mean, it would be a nice thing to do to give them the, you know, upfront statement that it's, just an evaluation period, but there's no legal effect to an initial evaluation period.
Good, thank you.
For unemployment insurance, I think there was a question on that. That's, if they're an employee, you just have to pay that for the first $7,000 of wages per employee per year. It's not like you get exempt if you pay them uh, very little or a low hour rate.
Okay. An anonymous attendee, there's two questions, but I'm just going to combine them because I think it's similar. The NFLT, um, it's regarding that. So if you owe and you work out a payment plan with the IRS for what you owe, do you get a chance to pay before they issue the NFTL?
Yeah, I would need to look into this. My instinct would be yes. It wouldn't make much sense to me that they would put a lien on your property when they've just agreed to a payment plan with you. But I will look that up and see.
Okay. This will be our
Right.
final question. Oh, go on.
Oh, I was just going to say that typically for an installment plan, they won't file a lien unless it's a partial payment plan. And even then, there's like intricacies there, like if you owe like more than $50,000. But if it's a full payment plan with, especially one that's within like the 3 years or 72 months, they typically wouldn't file a lien.
Okay. Thank you, sir. So this would be our last question. So should someone who is on Social Security disability insurance deduct the taxes out of their benefit? Does this help them in any way to deduct?
Yeah, I'm not 100% sure. I don't think so. I think you still have to pay the Social Security tax as an employer, even though you personally are a recipient of disability benefits.
Okay.
I don't know if Sarah or anybody has anything on that because I'm not sure, but it
Was
wouldn't make
this a
much sense to
question
me.
about having to pay the tax for the employee, or if like saying if you're a recipient of Social Security disability insurance, whether you should be like withholding a portion for taxes?
The latter. Yeah.
Okay, so that depends. If your Social Security disability and all other income is less than $25,000, then you don't have to pay taxes on the benefits. But if your income is higher than that, then you will have to pay taxes on 50% of your benefits, in which case withholding is good, just like as we were saying before, like you want taxes are pay as you go, so you want to pay throughout the year in order to avoid interest and penalties.
Okay. So thank you very much, everyone, and especially our guest speakers. Your wealth of knowledge really helped us better understand the tax landscape and just being able to understand the compliance and then being prepared for this tax season. With that, I'd like to thank everyone for attending today's webinar. And again, we will be sending a copy of today's recording along with the slides. Like I mentioned, or like our speakers mentioned today, they don't prepare taxes. I know there was one question about them being able to reach out to you. You can let me know how you like that, or you can just enter your contact information in the chat. I can send your contact information or the appropriate referral. It's part of the webinar recording and slides. So thank you everyone for joining us today, and you have a great rest of your day.
Thank you, Vero. And yeah, just to confirm, the way to contact the attorneys is through BetSedec. As part of our services, people will need to send an application to the program, and then when necessary, we will connect you with a pro bono attorney, which will be anyone on this team. So yeah, please contact BetSedec, and we will be able to make the referrals. Thank you, everyone, and have a good rest of your